Welcome, I'm Catherine Magana here with Steve Wolf, Greg Carroll, and Vince Stefano, where we're here to provide you some insights on the markets, investing, and planning. I know we missed last week, but here we are again this week. And it looks like April was a little volatile. Markets were down a little bit, but here we are in May, first week in May, and looks like we recovered a little bit. And what's really led the way, looks like, is utilities and consumer staples. But when you look year to date where we're at with the S&P 500, we're actually almost at the 52-week high. So it's been up and down a little bit, but here we are. And then the Dow Jones, we're off a little bit from the 52-week high. But I think all in all, considering what we've gone through this year to date, I'm okay where we're at with the returns so far.
Yeah, I'd agree that that first quarter was quite strong. So taking a little breather in April, I think was healthy for the market overall.
I think what's healthy for the market is this sideways action.
Yeah.
It needs time to digest the gains. And it could go down and digest it that way, or we could go sideways. So I think we'll probably go sideways for a while, and that's okay.
Absolutely.
That's true, because the longer the base, the bigger the upside. And that's typically the case because most momentum people will start getting out of these stocks that they don't want to be in. And as you continue to base in a stock, more and more of longer-term investors will start looking at these as good opportunities. So, look for companies that are basing and buy them.
I also wonder if we're starting to look beyond what the Fed is going to do. We've been Fed watchers now for too long, and wondering when they're going to raise, when they're going to lower. I think we're getting past that. I noticed that the mortgage rates, although they're still over 7, they were down slightly. I think I heard from about 7.2 something to about 7.0 something. Still a lot higher than they were, but if you look historically, they're just a little bit high. They're not a lot high.
Yeah. I think that you see right now also, I know we talked about the Fed and are they going to raise rates? Now we've gone back and forth, but it does look like potentially 2 rate cuts between now and the end of the year. I don't know if we're going to see anything in the summer, but anything can change. I mean, it seems like every month, every week, there's something different that comes out. But it does look like when I was looking at some of the short-term rates right now, I mean, those rates are pretty decent because obviously rates haven't changed.
Yeah, I saw them today at 5.4% for a 3-month T-bill.
Yeah.
But again, I mean, the Fed's been coming out with a very hawkish stance. I mean, Powell and his buddies are, they come out, his gang, they keep talking rates, stable. They're saying they're not going to cut rates unless the data allows them to. And what's happening is, as you said earlier, Catherine, the market's been very volatile because of that. But it seems like investors are buying the dips. And so, they're focusing on these sell-offs, not only because of interest rate worries, but also macroeconomic worries, or even earnings per share misses on some of the companies. And investors are stepping in and buying these companies. And, I think that's pretty healthy for the market overall. So, I think that, focus is on rates, focus on inflation, but I think investors have to stay invested right now because go away in May and coming back at a later day, I don't think is going to work this year.
So it's interesting. I was just looking at the inflation rates for the last few years. So as of March of 2024, we're looking at 3.5%. But then I looked back to say, okay, where were we in March of 2023? We were at 5%. And then March of 2022, we're at 8.5%. So there's been a lot of changes over the last few years. I know I personally feel like it's higher just based on what we're spending, but it's interesting to see how much has changed. And obviously the Fed is keeping their eye on inflation too.
Well, I know we're having inflation because, I'm doing my own little study here, and I hope all of you guys appreciate that I'm going to get fatter than heck because I'm going to all of the fast food places and ordering similar things to see how much they cost. And so far, the highest cost has been Five Guys. And I think for a burger, fries, and a Coke, it was about $21 or so, including taxes.
That's outrageous. Oh, my gosh.
And so I'm going to keep track of this, and maybe on a weekly or monthly basis, we'll talk about where we are. And again, I hope you guys appreciate that I'm ruining my health.
You are taking one for the team,
well,
Steve. Good
the
for
good
you.
thing is Lily's got a great drug that'll help that weight loss. I'm not recommending Lily to anyone, but it does have a good weight loss.
Yeah, I think I may need heart issues, or heart medication rather than weight loss.
So it's interesting how California had their higher minimum wage that came into effect, which is kind of one of the reasons you're seeing these higher prices. But on the other end of it, I actually ordered a pizza a couple weeks ago, and the delivery for that, it actually took almost 2.5 to 3 hours for me to get this pizza delivered.
Wow.
And yes, so I'm not going to order pizza delivery
was it a
anymore.
What did you order through?
And so I just, I think it's part of that is they only had one driver, and I don't know if based on the cost and everything. So I'm going to have to rethink. One, do I go to them, or two, do I just pick up my pizza, which I could have done? But it's interesting.
That brings me back to something I've said time and time and time again. I wish somebody would finally listen to me, that raising the minimum wage does nothing but raise prices. So the bottom is still going to be the bottom no matter where it is. You can raise it to $100, and then the manager of that place is going to say, well, if the person who's washing dishes is getting $100 an hour, I'm worth more than that, and then ultimately it has to come through in prices. So, the answer to getting people to be more wealthy is not giving them more of a minimum wage. That is not the answer.
It's not a living wage. It's a starter job.
Well, it still doesn't matter. Whether it's living wage, starter job, it's minimum.
Yeah.
Okay? And it will never be more than that. Minimum is minimum.
And I think they're disadvantaging some of the local mom and pop, restaurants too, because the minimum wage is for these franchises, across the country and everything. But, I don't know was that a franchise that you ordered your pizza from?
It was, yeah.
Because you might have a local mom and pop one, but who's going to go work there for $15 an hour when they get $20, at Domino's or, one of the big chains? So
well, didn't you order like a 42-foot pizza and they needed to have a truck or something to get it there?
And then I would be okay. I would be okay with a 2.5, 3 hour delivery.
So another topic here. I know some of the tech stocks have done very, very well, and one or two especially. And what's happened is in many portfolios, those one or two positions have become outsized. And, we talk about concentrated portfolios a lot.
Yeah.
And how it is a way to get wealthy, but in a whole portfolio, it's probably too much to have when you've got 25% in one company.
Absolutely. Yeah, that's too much concentration.
Right. I mean, a lot of people who've worked for some of the big tech companies over the years, who've worked for them, and they get stock options and this, that, and the other thing, and they're highly concentrated in that, have gotten very wealthy. But once you're now past that and you're investing your portfolio, do you really just want to be in one or two stocks? The answer is no, just because it's just too risky.
It's interesting. We actually have a new client that we just started working with, and he had a concentrated position. He has actually, when he came over to us, he now has cash, but he said it did really well at one point, and then it didn't. And so the hard part is if you have one company and you're invested a lot of your money in, if it goes the other way, then potentially there's a lot of loss. But but another stock he had owned concentrated, he did really well on, so he thought he could do it again. But the reality is now he's like, okay, I want to turn it over to you guys. I want to have more of a plan and a strategy in place. So once again, yes, you can make a lot of money, but there's also that other side where you can lose too.
Exactly. And when you're 60, 65, 70 years old, or even if you're 50, 55, and you've got a position that's 25, 35, 40% of your portfolio, that's a lot of risk, after you've made a lot of money. Remember, the object here is to make it and keep it. It's not necessarily I'm going to hold it forever. The other thing, too, to think about is a lot of these concentrated positions, they're up 2,000, 3,000%. Well, from here, are they going to do that again? The chances are, if they do, it will take a long time.
Decades.
Yeah. So, the next move up may be 10, 15%, and there's a lot of stocks that can make 10 or 15%. So why not spread that portfolio out?
Yeah, you can't get too attached. You can't be emotionally attached to any investment because that's where we always make the wrong decisions. If we think about it logically, and if you told them they had to start from scratch, would you put 25% in one investment and spread the other 75% amongst 10 or 15? Probably not. Probably not.
Well, you're right, and we all get attached to certain things. I know we've had people whose parents have died and they left them stock and they don't want to sell it because it's
sentimental.
It's
like,
sentimental.
Yeah. It's like, oh.
Well, the stock doesn't care.
Yeah.
So you can't get married to a stock.
I agree. I think from a standpoint of stocks, and I think investors have to continue to look at the earnings and the revenue streams of companies. And I know you mentioned technology, and if you look at what happened with the first quarter earnings, they were actually not that bad. The S&P earnings grew at about 5.2% year over year. And analysts for the second quarter have estimates close to 9.8%. So, earnings, they're the mother's milk of stocks. So, I mean, keep focusing on the companies that are dominant, rapidly growing, have really good earnings, throwing off cash flow, solid operating margins. And, whether you have a 5%, 6%, or 7% position in your portfolio, those are the kind of companies that continue to do well. Some of the outsized positions you were talking about, no, I think that's, even for me, a person who loves stock.
Who's never met a bond he didn't like.
Or an annuity.
or I should say, who's never met a bond he did like. Yeah.
I would say that any position over 10% is way too high.
Yeah. And of course, it depends on every individual. Okay, everyone's different.
Yeah,
but
but
in general, I would say 10, 15%, you're starting to get there. And when you get up to 25, 30%, it's a lot. And, you talked about earnings, and it's interesting. People don't seem to look at earnings as much as they look at price.
Mm-hmm. They look at the performance. How is the stock done? They didn't look
Right.
at
And you've got to look at both. The stock price is not necessarily what the stock is worth. Okay, it's worth that at that particular moment in time. But if someone is earning a company is earning 3% a year, and it's trading at 300 times its earnings, well, more than likely it's going to come down. So sell that thing.
Yeah, if you've got a stock at 300 times earnings, definitely sell.
And one quick point on that, it's kind of interesting. A lot of stocks that have sold off pretty aggressively in the first quarter earnings season, they met their report for the fourth quarter, for the first quarter, but their guidance for Q2 and the year may have been in line or down, and that's what caused the stock to decline substantially. And those are the kind of companies that investors really should look at, because there's nothing wrong with those companies. You miss one quarter, it doesn't mean that it's a bad stock. It could be for a number of reasons. So focus on these companies that have really had sizable declines, and once they start to base a little bit, start thinking about adding to their portfolio.
The other thing to start thinking about, too, if you haven't already, are some alternative investments. A lot of people don't even know what some of these alternative investments are, and I know there's a lot of do-it-yourselfers out there who are just missing out on probably 40% of what could be in their portfolio that could really help the portfolio when you're looking at alternatives. So maybe we should do a whole podcast on just the alternatives, but it definitely is a place to look at, other than stocks and bonds.
If you had to define what alternatives are, how would you say that to someone who doesn't even understand what that encompasses?
Well, I'm going to say alternatives to stocks and bonds.
Okay.
It could be public, it could be private, it could be an income-oriented investment, it could be a growth-oriented investment, just something other than stocks and bonds. And cash.
And mutual funds and ETFs that own
that
those
represent
things.
those.
Yes.
That's correct.
Gotcha.
A great idea. I think we definitely can have a discussion a little bit about that, maybe one of our upcoming podcasts, because there's obviously a lot of moving parts with that, but definitely we can go over that.
All right. Well, this has been another week. Today is May 9th. So we'll see you guys May the 16th, hopefully. And until then, thanks a lot for listening. Bye-bye.
Great.
Bye now.
Thank you.